Welcome to Money RX for CRNAs and nurse practitioners. I'm Brett Fellows. Today we're talking about something that comes up regularly in my world. Rental property. Should you buy one? Is it the retirement play that everyone says it is? And will it get you to financial independence faster? Now, I want to start by saying something you might not expect from a financial advisor. Yes, rental real estate can absolutely build wealth for you, 100%. And it's done it for a lot of people. So I am not here to tell you that real estate is bad. But here is what I have seen over the last 20 plus years of working as an advisor. Many people who buy rental property never calculate the one number that actually tells them whether or not it worked. Not the purchase price and not what it sold for. The all-in, after tax, after expense, after time, annualized return. And when you actually run that number for a high-earning nurse buying the kind of property that she wants, at today's rates, it often lands in a range that surprises people. Before I jump in, I wanted to make sure that you knew Oak Capital Advisors is currently accepting new clients for summer 2026. If you are a CRNA or a nurse practitioner looking for a financial plan built around your income, your accounts, your timeline, you can schedule a free introductory call at connectwithbrett.com. Okay, today I want to show you how to think about real estate the right way. We will walk through a real case study and we will look at 3 things that change the math at your income level. And I will give you a framework for deciding whether or not a rental property belongs in your retirement plan. Let me tell you about Yvonne. Yvonne is a CRNA in the Charleston area. She's 55 and she earns around $220,000 a year. She wants to retire at 62. Now, back in 2019, she bought a single family rental for $300,000. It's a nice property and has a very good tenant. Her husband, Greg, is 57. He's supportive, but he's quietly dreading the idea of being a landlord at 65. So now Yvonne wants to buy a second property. She wants a nicer one, about $525,000. And her reasoning is straightforward. More real estate means more retirement income. But before she did anything, I asked her one question. What has property number 1 actually returned after everything since 2019? Now, she knew the property value had gone up, and she knew that the rent had covered most of the mortgage, but she had never run the number like I asked. And when we ran it together, 3 things showed up, and all 3 of them come from the same place. So the financial math that works at $60,000 a year in income stops working at $220,000 a year. So problem number 1, I call the illusion of cash flow. When Yvonne bought her rental in 2019, she ran the numbers the way most people do. Rent minus mortgage equals profit. Now that calculation obviously left a lot out. Things like property tax, landlord insurance, and maybe a maintenance reserve. And property management, because Yvonne surely is not going to stop working clinical shifts to manage a tenant herself. So when we added it all up, the property runs at about $335 in a month in the hole. This is before a single vacancy, and this is before a single repair telephone call. But now consider the property that she wants to buy next. $525,000, an investment property loan at 7.4%. At current rates, the monthly payment alone on a $390,000 note is around $2,700 a month. You add taxes, insurance, maintenance, management on top of that, and the property needs $3,400 a month just to break even. The market rent in that area is $2,800. So it's $600 a month in the red before anything even goes wrong. Now, social media math about rental property was written for buyers at 3% rates. We are currently, my friends, at 7.4% for investment property loans right now. So social media advice did not update when the rates did. Keep that in mind. Which brings me to problem number 2, the write-off that isn't. When Yvonne bought in 2019, her CPA mentioned depreciation. Great write-off, he said. Well, here's how depreciation works on paper. A residential rental property depreciates over 27 and a half years. On a $300,000 property with $60,000 in land value, that's $240,000 that's depreciable. You divide that by 27 and a half years, and that's $8,700 a year in paper losses. Now you add that to actual operating losses, and Yvonne has roughly $13,000 in rental losses per year. Now in theory, she could deduct that against her clinical income, but in practice, she cannot use a single dollar of it. The IRS allows up to $25,000 in rental losses to offset your W-2 income, yes. But that allowance phases out between $100,000 and $150,000 of modified adjusted gross income. After $150,000, it is completely gone. So Yvonne earns $220,000, remember. So her passive rental losses are suspended. They just sit there on her tax return doing nothing until she either sells the property or her income drops below $150,000. Now, you may have also heard about bonus depreciation, cost segregation studies, accelerated write-offs. Under the tax law signed in 2025, 100% bonus depreciation is back permanently. And a cost segregation study can reclassify a big chunk of the building into personal property that writes off in year 1. That sounds powerful. But there are 2 problems with it for a nurse at Yvonne's income level. First, even with bonus depreciation, the losses are still passive. The $150,000 Maggie phase-out still applies. So for Yvonne, those deductions are still suspended. Now, the only way around this is becoming a real estate professional status. And to qualify, you need more than 750 hours per year in real estate activities. Oh, and by the way, real estate has to be more than half of your total working time. Well, for Yvonne, she works 2,000 clinical hours a year. So that means she's going to spend more than 2,000 hours managing property just to qualify? I don't think so. And second, depreciation is deferred. It's not free. So every dollar you write off lowers your cost basis. But when you sell, that depreciation comes back, and the IRS calls it recapture. And it is taxed at up to 25% on regular depreciation. On the accelerated portion, it comes back as ordinary income to you. So if you think about it, you borrow the deduction from your future self, and your future self pays it back at sale on top of capital gains. Which leads to problem number 2, what the exit actually costs. So when Yvonne said her rental had been a great investment, she meant that the value had gone up. And it had. The $300,000 property is worth about $390,000 today. Well, that's $90,000 gain over 6 years, which is strong. But let's run what the exit actually looks like. First off, there's realtor commissions, which average 5.7% in 2026. Add closing costs, depreciation recapture, long-term capital gains tax, state income tax in South Carolina. And note that the gain itself pushes your Maggie higher in the same sale year. That can trigger the 3.8% net investment income tax on the amount above the threshold. So when you run the full exit after everything, the 6-year annualized return on Yvonne's property came in around 6 to 7%. Comparatively, her 403b over the same 6 years compounded at the market return of roughly 11 to 12%. And guess what? There's one more cost that doesn't show up in any spreadsheet: time. So Yvonne spends about 20 hours a month on the rental property. This is dealing with telephone calls, repairs, general coordination, bookkeeping, the like. Well, at her clinical rate, that's around $2,300 a month in time value. Over 6 years, that's roughly $165,000 in time that went into an investment returning 6%. And when she needs to sell, she does not get to pick the day. The median time to close a property sale is 37 to 77 days, depending on market conditions. Well, she can sell a Vanguard index fund in 30 seconds on any business day. So the cash flow illusion put Yvonne in the red every month. The suspended depreciation meant that she got no tax benefit from those losses. And the exit math showed a 6 to 7% annualized return after everything in a market that returned 11 to 12% on her 403b. So the rental had not failed her, but it had not beaten the accounts she already had. And the nicer $525,000 property would have started $600 a month in the red. So the question isn't whether rental real estate builds wealth. The question is where your capital works hardest at your income level. In this instance, I like to use a framework called the capital priority ladder. So the capital priority ladder puts every account and every investment in order of efficiency for high earning nurses. And it answers the question before you write the check. Rung number 1 on this ladder is to max every tax advantage account you have access to. 403b, 457 if your employer offers one, backdoor Roth IRA, HSA savings account. For a dual income nursing household, total contribution capacity can reach up to $90,000 a year or more. So every dollar you contribute reduces your taxable income now, and it grows with no annual tax drag. You have zero management, you have zero tenants, you have zero midnight phone calls. Next up on rung number 2 is a taxable brokerage account with low-cost index funds. Here you have no contribution limits. And in retirement, if your income stays below the threshold, long-term gains and qualified dividends can be taxed at 0%. We like to call this your flexibility layer. Then we move to rung 3. So if you want real estate exposure, we recommend buying a real estate ETF or REIT fund. The Vanguard Real Estate ETF costs 0.13% a year, and it holds hundreds of properties across every property type. Historical returns are comparable to direct ownership, and you can sell any amount on any business day. Now, a REIT inside of a Roth IRA is particularly useful because REIT dividends are normally taxed as ordinary income. That's actually their biggest drawback. But if you put it inside of a Roth, they grow and come out tax-free. So you get real estate returns with the best available tax treatment, and again, zero management overhead. And not until rung number 4 do we recommend direct property ownership. So for nurses who have maxed out every account and have a full emergency fund reserve, they carry no high interest debt and genuinely want the hands-on experience. Well, at that point, a rental property can make sense. But again, I caution, most nurses I see have not finished rungs 1 through 3 first. Yvonne hadn't. Her 457 was completely empty, and she had never done a backdoor Roth contribution. Her HSA was going unused as well. So between her Roth, her 403b, her 457, and a family HSA, she had about $71,000 a year in tax advantage contribution room that she was not using. Every dollar in those accounts either reduces her taxable income now or grows tax-free forever. But she was skipping all of it to own a property running $335 a month negative. So here's what changed when we worked through her ladder. She held the first property. There's no hasty sale, but she didn't buy the second one. She started to max out her 457B for the first time, and she also started backdoor Roth contributions for herself and Greg. She opened an HSA and she put the additional capital that she had into a taxable brokerage with a REIT allocation inside of her Roth. In her first year on the new plan, she sheltered $71,000 from taxes. That reduced her federal tax bill by roughly $22,000. No additional tenants, no additional management, no negative cash flow. So 3 things to take with you from today. 1, at today's investment property rates, most rentals in mid to high cost markets do not cash flow positive in year 1. So definitely run the full cost breakdown before you commit 6 figures in capital. Mortgage, taxes, insurance, maintenance reserve, management, all of it. 2, the passive loss deduction disappears at $150,000 modified adjusted gross income. For most CRNAs and many dual income NP households are above that line. Now the depreciation is real, but the ability to use it while you're working is not. And when you eventually sell it, it comes back. And number 3, before you buy a rental, work through the capital priority ladder. Max out your 403b. Check to see if you have a 457. Open a backdoor Roth. Fund your HSA. If there's still money left and you want real estate exposure, well, a REIT inside of a Roth gives you comparable returns with the best tax treatment available. If you want to run your own all-in return or just figure out what the priority looks like for your household, that is exactly the kind of thing we work through. Feel free to click the first link in the description to schedule a complimentary retirement review. Thanks for listening to Money RX for CRNAs and nurse practitioners. I'm Brett Fellows, and until next time, take care of yourself and take care of your money.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.